Tantor Audio, a division of Recorded Books, presents The Everything Guide to Investing in Cryptocurrency. From Bitcoin to Ripple, the safe and secure way to buy, trade, and mine digital currencies. By Ryan Derousseau. Narrated by Rich Miller. The Everything Guide to Investing in Cryptocurrency. Dear listener, after over a decade of covering investing topics as a journalist and writer, it's rare for me to see much excitement in the tools we invest in. Sure, everyone is out to get rich, but normally investors reserve their adrenaline for specific stocks, while portfolio managers stick to whatever strategy they're pitching. Most veteran investors hardly allow a hint of emotion trickle as they lay out their thesis. Maybe that's why I found Bitcoin so interesting when I got my first chance to write about it a few years ago. Supporters used emotional pleas to convince the world it wasn't just a currency or just an investment. It was a way of life, a philosophy. Despite this enthusiasm, few could legitimately predict what would happen to Bitcoin in 2017, when suddenly some of these advocates turned into millionaires. Discussing cryptos then turned into a much larger conversation, as supporters were emboldened by the price appreciation. Expressing skepticism in the crypto discussion seemed on par with rejecting someone's religion or worldview. The problem? People weren't just investing in cryptos. They were placing their hopes and dreams on the rise and fall of a coin that had no long-term track record. That's why I decided to write this book. It's a detailed introduction to what a new crypto investor should know about these coins, beyond the blind narrative that they're destined for growth. With this information and basic understanding in hand, you can form a calculated opinion of a coin and the risks involved, and determine for yourself just how much you're willing to put into either the future of currency or simply the next in a long line of investment fads. It's up to you to decide. Ryan Derousseau. Introduction. If you've been following the news, you've probably heard about something called cryptocurrencies. You've heard they can appreciate in value by hundreds of dollars. You've also heard that their value sometimes crashes overnight, never to recover. You've wondered if you should invest in them. But just what are cryptocurrencies? This book answers that question for you. It tells you what cryptocurrencies are, why they're important, and why you may consider investing in them if you like to gamble. You'll also look at questions like, how is the value of cryptocurrency such as Bitcoin determined? What's a blockchain, and why is it important to cryptocurrencies? What purpose do these things we call cryptocurrencies serve? How do you make money from cryptocurrencies? How life-changing will these currencies be in the next decade and beyond? If you're thinking of investing in this new field, it's on you to conduct the research and delve into what makes a new cryptocurrency different, unique, or special. Since it's such a new market, the research you conduct will determine how much you believe in the future of cryptocurrencies. There's almost unanimous consensus about the potential of the blockchain. Some claim the blockchain is the most important invention since the internet itself. Billions of dollars have flowed into it. Where cryptocurrencies fit in a future where the blockchain is ever-present will determine whether these coins can pay off big in your investment portfolio. No one wants to miss out on a big payday if cryptocurrency really takes off. Investing in Bitcoin or another cryptocurrency is like any other kind of investing. The more you know, the better and more intelligent your strategy will be, and the greater the chances are that it pays off. This book will give you the guidance and initial understanding of the concepts and strategies used to safely invest in cryptocurrencies. It's a resource to provide you with the tools so you can safely explore this new world. With the Everything Guide to Investing in Cryptocurrency in your hand, you can step confidently into this new world of investing and hope your money will grow. This book tells you what cryptocurrencies are, why they're important, and why you may consider investing in them, if you like to gamble. Chapter 1. Welcome to the cryptocurrency craze. In a matter of only a few years, Bitcoin has transformed from a theory into one of the era's most closely watched and intriguing investment trends. Potential for the coin and other cryptocurrencies now run the gamut, depending on whom you talk to. Some prognosticators have argued that the price of Bitcoin will reach beyond $100,000. Many others claim it's a bubble on the level of the largest market mirages in history. Such is the world of cryptocurrency investing, where the truth likely lies somewhere in the middle. Now that you're thinking of entering the space, make sure to embrace some of that excitement, but also keep in mind what you're buying when you declare yourself a crypto investor. It's far more than purchasing a digital coin. This chapter offers an initial explanation of cryptocurrencies and will serve as a first step on your new journey. What are cryptocurrencies? At its basic level, cryptocurrencies are a very simple concept. They're digital coins created online and meant for online spending. Developed via software code, cryptos are a way to transfer value, most often via digital means, like when you're purchasing something online. E-fact. While the spending of bitcoins launched on the internet has primarily been relegated to the online world, there are ways in which you can use them in your everyday shopping. The payment processor company Square gives its merchants the option to accept bitcoins. This allows any shop that uses Square's functionality, from the antique store to your local coffee shop, to accept bitcoins. Take a very simple scenario, such as using a quarter to purchase a piece of gum. When you buy that gum, you're giving the quarter to a shopkeeper in order to pay for the slice of gum. The quarter is a tangible coin that a U.S. shopkeeper trusts. He knows that if he takes the quarter, it will cover the cost of the gum and the profit that he expected to gain from the sale. It's a very predictable transaction. A quarter's value doesn't change all that dramatically in a short time. What will cost 25 cents today will likely run 25 cents tomorrow. Over many years, that quarter won't buy you as much due to inflation, but for the short term, it does, which is valuable for commerce. One Bitcoin is essentially the same as a quarter, except it's not tangible. It's a piece of code, and only you, as the owner, have the identifier, which is known as the coin's key. You can pass that identifier on to someone else in order to purchase an item. That person then receives a new identifier for the Bitcoin, and the old identifier becomes obsolete. You can't actually hold Bitcoin. You can't feel it. But when someone accepts Bitcoin, she is viewing it the same way as that quarter. But one Bitcoin has grown to become much more expensive than one slice of gum. That's because a whole community has grown around the cryptocurrency craze, willing to give Bitcoin owners more and more for that one coin. Why would anyone want this digital coin? If Bitcoin and other cryptocurrencies function just like regular money, then why would anyone want to use them instead of the fiat currency, that is, the regular currency, that we all are used to? It's a fair question, one that the world has only begun to sort out. The answer depends greatly on who you are and why you're choosing to use the coin. The anti-Federal Reserve crowd. Early adopters saw Bitcoin as a tool to spend without requiring a central bank to dictate the terms of the currency. Regular currency, like the U.S. dollar, is subject to inflation. This is, to an extent, controlled by the Federal Reserve. It increases or decreases the amount of money flowing through the world markets through its use of interest rates. On a very basic level, when there's more money flowing into the market, then the supply rises, decreasing the value of $1. When the Fed restricts dollars, then the value rises. The Federal Reserve does this to retain a consistent inflation rate, so the economy doesn't grow too fast. Hypergrowth can lead to an overvaluation of the goods you purchase, which would hurt the currency. Hyperinflation leads to a devaluation of the currency altogether, and the Federal Reserve is mandated to try and hold inflation in check. E-alert. This is a very simplistic definition of inflation. Since the economy has become global in nature, there are a lot of factors that would increase demand in the US dollar, like a devaluation of a foreign currency. The Federal Reserve must account for all of those factors as it sets interest rates. Digital coin enthusiasts don't believe that government entities should have the power to dictate these fluctuations in the money supply. One of the original goals of a cryptocurrency is to avoid inflation altogether. That's why Bitcoin has a maximum number of coins, 21 million, it can ever have in circulation. The business case for cryptocurrencies. What started as a libertarian dream, however, actually has a legitimate business use. It costs money to spend money. As odd as that is, there's a reason banks and financial institutions have grown so large. It's because they can collect fees in countless number of ways as money moves through their systems. For businesses, this can become very costly. One of the easiest ways to imagine this is when you're going on a trip to Europe and you have to exchange dollars for euros. When you go to the exchange counter at the airport, you not only receive less money back than you put in, because the dollar is worth less than a euro, but you also lose a large chunk to a fee that the exchange agency charges to give you the euro. Now imagine that on a wide scale, where a business is making exchanges in the millions of dollars every day. Clearly, there is an incentive to reduce that cost. E-fact. The U.S. Treasury handles the actual dollar development and distribution, but it's dictated by the interest rate determined by the Federal Reserve. If the Fed decreases the interest rate, then it encourages banks to borrow more funds, since the cost has dropped. Rate increases discourage borrowing, since it's expensive, and therefore less money flows through the financial system. That's where a digital coin has an advantage, since it isn't tangible. It can serve as an independent third party. Instead of going to a teller, you could use Bitcoin to exchange the dollars by buying Bitcoin with US dollars, then selling them for euros once in Europe. The transaction is processed on Bitcoin's decentralized platform, leaving the transaction fee for processing the digital coin as the only fee the company has to pay. That saves you the cost of the much higher exchange fee created by the middleman. Financial institutions and other organizations are seeing the value of that, particularly in areas where the local currencies aren't as stable. The everyday use of cryptocurrencies. When evaluating why you and other regular spenders of currency would want to use cryptocurrencies, the discussion becomes a little more difficult. While there are benefits to a digital coin that's unhackable, lives online, and will transfer almost immediately to the retailer when you purchase an item, it hasn't outweighed the ease of use and trust in the American dollar. Whether cryptos become a more prominent tool for everyday purchases depends on the ease of use. Regular consumers are going to spend the currency that's safest and simplest for them to use. Right now, that's the US dollar. If there was a reason for Bitcoin or another cryptocurrency to replace the US dollar, and it was as easy to use as dollars are today, then it could grow. But that reality hasn't presented itself yet. It's, however, still early days in the cryptocurrency usage. To get a sense of just how early, let's look at how the entire market began. An origin story. Maybe you believe you already know how you feel about cryptocurrencies. Maybe you're listening to this to get an understanding of what exactly cryptocurrencies are before rushing to judgment. Either way, you should know where they come from in order to theorize about their future. Their origin story also provides a backdrop on why the technology supporting cryptocurrencies has the potential to shift the way the world operates. Satoshi Nakamoto and the creation of Bitcoin. Bitcoin, the original cryptocurrency, has an origin story that contains a number of mysteries, mostly because the creator of the coin has never come forward and proven that he or she published the concepts that would launch the crypto craze and form what you now know as Bitcoin. In 2008, an author using the pseudonym Satoshi Nakamoto published a paper outlining a new structure to develop a decentralized peer-to-peer currency. In the paper, Nakamoto explains the concept of the blockchain, which produces a decentralized digital ledger and will become the backbone to Bitcoin. Many enthusiasts had attempted to launch a digital currency in the early 2000s, but it wasn't until this framework published, in which the notion of the blockchain was described, that the ability to structure a currency completely decentralized from any oversight was shown to be possible. The author of the paper remains a mystery to this day. Nakamoto's vision worked because she or he conceptualized the notion of removing the requirement of trust in order to process a payment. For instance, when you pay by check, you're trusting that the bank will provide the funds to the vendor based on what's in your checking account. The vendor accepts the check, trusting that the bank will ensure you have the funds for the service provided. The concept Nakamoto described removed the notion that vendors and consumers needed a third party, such as a bank, to provide this trust. Instead, this blockchain, or digital ledger, would verify the information as the transaction unfolds. Therefore, if you were trying to spend all your bitcoins on a car, the blockchain would first double-check all the transactions ever provided by you to ensure you have the funds to supply the car dealer with the amount of bitcoins required for the purchase. Trust is no longer a factor. The blockchain verifies that you have the funds. This opens up dramatic opportunities to bypass traditional financial systems. To this day, despite many efforts to uncover the person or group behind the pseudonym, the identity of Nakamoto remains a mystery. Some have claimed that Craig Wright, an Australian entrepreneur, is Nakamoto, but efforts by Wright to prove this have fallen short. E-fact: Nakamoto has an estimated 980,000 bitcoins, based on analyses done in the early days of Bitcoin's popularity. If this number holds true, then when Bitcoin's price rises, Nakamoto's crypto wealth matches some of the richest people in the world. At Bitcoin's peak, Nakamoto's paper wealth placed him just behind Paul Allen, the co-founder of Microsoft, on the Forbes 400, the wealthiest in America list. Bitcoin changes everything. Shortly after this concept paper was published, Nakamoto created the first Bitcoin. This technological breakthrough, the blockchain, separated Bitcoin from all other previous attempts to develop online or digital currency. From this code and concept, many other cryptocurrencies have been birthed in an effort to fix problems within Bitcoin, improve upon what Nakamoto started, or to jump into the cryptocurrency craze in search of a quick buck. All cryptos have their own origin story. While you won't find many cryptocurrencies' origins as unique as the patriarch coin, Bitcoin, they all have their reasons for existence and a purpose for using them. The first piece of advice in investing in cryptocurrencies is to understand and recognize these origin stories. It's the first chance you have to see whether it's a legitimate tool or a scam. Who is behind the cryptocurrency? Does it seem to be a viable concept? Does it make sense to link a cryptocurrency to this concept? Listening to these narratives will be a first step in recognizing what's worth investing in and which cryptocurrencies have value. The blockchain. Without a computer science degree, it's not always easy to conceptualize the blockchain. It's essentially a digital ledger that tracks transactions within its code, providing a public, searchable, and infinite record of a cryptocurrency, or other item in which the chain was built to track. What's different about the blockchain, separating it from past attempts to develop a digital currency? It's important to at least tangentially understand the mechanics of the blockchain in order to grasp and differentiate between the various cryptocurrencies. Nakamoto developed the blockchain as he searched for a cryptographic answer to the digital coin. Cryptography is often synonymous with encryption or protecting data from outsiders. It's the effort to develop codes, systems, and mirages to protect data, scrambling it so no one can piece all the information together, unless they have a code that does it automatically. Often, this is done through encryption, which is a specific way to scramble the data so nothing can read it except the owner of the information. But in some ways, Bitcoin's blockchain also uses complete transparency to accomplish its goal. Although there are plenty of touch points in the coin purchasing process where encryption plays a major role, such as when you receive a private key to unlock your coins, lose the key and you lose the coins, the Bitcoin's blockchain itself is completely open, since others can see where those coins move over time. Each Bitcoin has its own digital signature, and each owner of the coin has a mark that represents his or her ownership. It sits within the ledger. This means each coin is tracked through an entire lifetime of its use. This creates a level of historic transparency, both for good and ill. For instance, the IRS can go back and track every purchase ever made with Bitcoins. It also means you don't need a third party, such as a bank, to process transactions, since the blockchain can do it automatically through this code, tracking every coin along the way. Digital contracts unlock blockchain potential. Since blockchains don't necessarily require a third party, they have created a new type of smart contract, which offers even more uses for the blockchain beyond cryptos. Ethereum, the company that developed the second most popular cryptocurrency, Ether, which also goes by Ethereum, created the digital or smart contracts first theorized by Nick Szabo, a sort of crypto philosopher, in the late 1990s. Blockchains that have the ability to create smart contracts can approve agreements that two sides initiate. For instance, let's say Company A wants to send $10,000 worth of Ether to Company B for coding services that Company B provides. Within the digital contract, there can be certain benchmarks that Company A demands that Company B must live up to in order to receive payment. As Company B works its way through those requirements, the project is tracked on the blockchain. It's like a digital project manager. At the end, no one needs to confirm that the requirements were reached, because the blockchain has traced every step, sending Company B the coins once it fulfills all the benchmarks. E-alert. Since Ethereum's breakthrough with smart contracts, a number of other companies have developed similar tools, trying to improve on the original concept. Part of your investment research is to ensure that there's an actual need for this improvement. One way to judge if another concept also has some legs is that there are companies putting money behind it, whether as an investor or as a client. These contracts have a dramatic impact on business interest within the blockchain landscape. IBM, for instance, is using the blockchain tools developed by Stellar's contract technology to conduct transactions among some banks in the South Pacific. At the time of the announcement, IBM estimated it would help conduct $1 billion of cross-border payments in this manner. The uses for these contracts go beyond international payments. Supply chain firms can incorporate such a contract to track movements of supplies, paying vendors once it receives shipments intact. It provides security in compliance-heavy arenas, since the rules around the compliance can be incorporated into the blockchain contract, ensuring business is conducted correctly from a legal standpoint. And it improves transparency, both internally and externally. Companies can use internal blockchains to track these movements, and then can turn to them when needing an accounting of shipments. The potential remains extremely significant. Some have likened the advent of the blockchain to the creation of the Internet, and businesses are only now beginning to figure out the various ways in which they can use the technology. Where do cryptocurrencies fit? Cryptocurrencies are how the blockchain confirms these agreements or transactions, depending on the situation. It's why when businesses use the Stellar blockchain, they will conduct the transaction in its cryptocurrency, lumens. Then the businesses can sell the lumens to cash out and obtain the value in their local currency. Imagine a currency exchange that was completely digital. This would be the blockchain where there are euros, dollars, and yen, along with lumens, bitcoins, and other digital coins available for transacting. A Japanese business could sell something in dollars, move the payment into lumens by adding it to the blockchain, and then send it to Japan, where it would cash out the lumens for yen. Instead of paying a huge fee on the transaction, they pay a very small price due to the blockchain and the cryptocurrency, lumens. The whole thing, in this case, would be tracked on the blockchain via the use of the lumens. Exchange of value. There are blockchains that don't require cryptocurrencies since there's no monetary transaction occurring. But in blockchains where there's an exchange of value, either through retail, services, contracts, investing, or lending, then the cryptocurrency is the token used to track the digital ledger. For instance, if Nakamoto sold his very first Bitcoin, then as it moved around the Bitcoin atmosphere, being bought and sold, there would be a stamp on the Bitcoin blockchain providing a digital map to everyone who ever owned the coin. Question. Does this mean that everyone will see what I purchase and when? No. The blockchain tracks through a series of numeric key identifiers. You won't see your name on Bitcoin's blockchain by simply buying a coin. But if someone had the resources, such as the IRS, they could find out by seeking information through the exchanges, which were built to more easily conduct crypto transactions. Where do cryptocurrencies live? Understanding where cryptocurrencies live takes a little imagination. It means we'll have to get into the intricacies of the computer science and design. Cryptocurrencies are decentralized, meaning the blockchain incorporates them to conduct business within its infrastructure. But the blockchain is a peer-to-peer network, so instead of living on one server, the blockchain's code lives on many different nodes. A node is a term used to describe the computers or electronic devices that have downloaded the blockchain's code. Imagine you created your own website on WordPress. In a non-blockchain world, it would live on WordPress's servers. In a blockchain design, your website wouldn't live on WordPress's servers, but on a series of computers that have opted in to run WordPress's code and store the various websites. This decentralization is a key aspect of crypto's design, since in many cases it allows a community of developers to determine the fate of the currency. Of course, if a computer were to help WordPress host the code, and therefore your website, you would expect them to receive some sort of payment to do so. We'll discuss this later in this chapter in the context of mining. How have they become a tool for investment? As more people or businesses use a specific cryptocurrency, it appreciates. Let's imagine the following scenario. Let's take Nakamoto's very first Bitcoin again and say it's early days in cryptos when no business accepted them. The only other person in the world who knows about Bitcoin is an owner of a sandwich shop. Now let's say Nakamoto, excited about going somewhere he can actually spend his new currency, buys a $5 sandwich with 1 Bitcoin. Now the value of 1 Bitcoin is $5. As more people become aware of Bitcoin, suddenly they're willing to sell far more for 1 coin. Now the sandwich shop owner can pay his $2,000 rent using the Bitcoin, since there's a larger community willing to spend that much for a single coin. That community's desire is tracked via the Bitcoin spot prices on exchanges, which calculate the current value of the coin. It's basic supply and demand. You invest in cryptocurrency because you're betting that the cryptocurrency you own will appreciate even further. Imagine that it's appreciated so far from its original value of $5 that now the sandwich shop owner could sell that original Bitcoin for a luxury vacation or a car. It's this price appreciation that people invest in. That's why it's important to understand the technology behind the cryptocurrency, since you'll need to determine whether it has the chance of having far more users than just a single sandwich shop. Who has joined in? In the past few years, as the price of these tokens has gone to the moon and back, traditional investment firms and exchanges have embraced the currency as a legitimate form of investment. The Chicago Board Options Exchange and the Chicago Mercantile Exchange began offering the trading of future contracts in late 2017, which opened up the opportunity for at-home e-trade users to buy and sell futures. The best-performing electronic trade fund in 2017 also invested in Bitcoin.
Sample complete. Ready to continue?